Hey guys, this is Alan from the equitytraders.com Academy Division, and I'm going to be discussing Learn to Trade Chapter 3 with you. Hope you've seen Chapter 1 and Chapter 2, a couple of videos just explaining the beginning understanding of what is trading all about, Chapter 2 about the stock markets and trading sessions. And Chapter 3, we need to understand that trading is a business. Yes, you're running a business. You've got income when you win a trade. You've got expenses, which start with brokerage kind of expenses, and your then net expense would be if you lose a trade. So when you are a successful trader, you have more income, sales, or more income than you have expenses. So if you're going to have no income or one winning trade, you're going to have income of one winning trade and 3 losing trades. Your 3 losing trades are going to exceed your one winning trade, and that is going to become an expense. Blowing your account is also an expense. So what I wanted to do was for you to understand that your trading account is a business account, and it needs to be run like a business. You're not at the casino, you're not there to gamble, because trading is not gambling. Trading is where you sit and work out analytically and fundamentally which direction the market is going, how the chart is going to be trading, whether it's trending up, whether it's trending down, whether it's ranging, and based on that, you're going to then be trading. And you're not sitting thumb-sucking, it's going to go up, I think. If you don't do analytics and if you don't understand the market patterns and the market's direction, you're never going to succeed as a trader. So let's understand what are the expenses which are related to a business, the business of trading. Learn to Trade Chapter 3. This can be found under the Academy section on our website below, under the Academy, Learn to Trade Chapter 3. So, broker expenses. What is a broker? What is a platform? A platform is the MT4 or MT5 or cloud trade platform software which is used to trade. You need to have a broker which is basically going to be receiving your deposit and which is going to be managing your account. When you lose a trade, you're giving the money to the broker. When you're winning the trade, the broker is giving you the money. Alright, does that make sense? So the broker then has expenses which they charge for you to be able to trade on their platform. So a brokerage fees are fees that your online brokerage charges when you have an active account with them. So they can't charge brokerage fees when you're on demo. So when you're trading demo, you are not getting to understand the full costs or the full effect of those fees. Okay? They might show them, but the feeling that you're losing just on the brokerage fee is important. And sometimes when you trade, you need to make sure that your brokerage fees or swap fees, for example, for overnight trades are not going to exceed your net profit at the end of the day. But we'll discuss that at a later stage. So the brokerage expenses vary from broker to broker. So there is no regulation in terms of how much they have to charge or not have to charge. And this is why brokers are competing for your money. They're offering high fees in certain areas, low fees in other areas, but generally there's a broker fee for every single trade. Don't be mistaken. Every broker charges a fee. So they vary from broker to broker and can impact your returns and your overall experience. Please ensure you know what your fees are. We have broken these down into non-trading fees and trading fees. So what are non-trading fees? Non-trading fees include charges not directly related to trading, such as a deposit or a withdrawal fee or an inactive fee. What is inactive? When you don't trade for 2 or 3 weeks. Trading fees are charged when you trade. This can be a commission, a spread, financing rate, margin rate, or conversion rate. So let's go and take a closer look at these one by one. Our recommended broker comparison, you can go and click on there and that'll take you to our two different kinds of brokers, being a funded broker or a non-funded broker. Go and have a look at Trade Nation and Audacity Capital, our partners. So our business costs. Trading fees are charged by the brokers in one of these forms of income, and they partly why they are in business as brokers. Let's go through them now so we can understand them, as they are basically costs to our business. Right. Types of online brokerage expenses. Commissions. Commissions, not everybody charges a commission, but commissions are usually based on traded volume or alternatively charged as a flat fee per trade. So when you go down to your trading platform, you can right click and add or deduct columns. Make sure that your commission column is active so that you can understand what are the costs. So on stock trades in European markets, the commission is usually based on the volume of your trade. For example, if you buy 100 BMW shares at £70 a piece and the cost is 0.1% of the volume, you will pay a commission of £7. This is for the buy leg only. If you sell, the sell leg will have a commission too. Please note that some brokers might have a minimum charge, like a $10 per trade. There are companies that do that. There are brokers that do that. So make sure that when you are choosing your broker and selecting your broker, what the commissions are. In the US, for example, in most cases, the commission is either a flat fee per trade, for example, $5 per trade, or calculated based on the number of traded shares, such as 0.005 per share. The latter method is not advantageous for you if the share price is very low, for example, under $1. In such a case, it will cost much more to buy, let's say, $1,000 worth of shares than it would if you bought stocks priced at, say, $100 a piece. Many brokers offer zero commission trading for stocks, ETFs and options. US investors especially have a very wide selection of free stock trading apps, and their disposal zero commission is especially useful if you're trading relatively low volumes, like buying stocks for less than $500 per trade, because you won't be hit with any minimum fees the brokerage might charge. So those are commissions. Swaps. Swap fee, also known as a financing rate or overnight rate, is charged when you hold a leveraged position for more than a day. A typical example of this would be a forex trade or a CFD trade. The leveraged position means you borrow money from the broker to trade. For this borrowed money, you have to pay interest, or in certain cases can also receive interest. This is the financing rate. So when you're going to trade and you want to hold the trade over into the next day, they're basically financing your trade to leave it overnight. And to leave it overnight into the next day, you then pay what they call a swap fee or interest fee. Weekends, you also pay swap fees. So day traders try and open their trades and close their trades the same day, so they don't pay swap fees. Scalpers are obviously open and close the same day, and they don't pay swap fees. Swing traders pay swap fees because they hold it for 2 days, 3 days, a week, even a month. So make sure you understand what your swap fees are. Spreads. Most of us are looking at the spread. The spread is the difference between the buy and the sell price, or in other words, the bid and the ask price. Make sure you understand what is the difference between the bid and the ask price. If you can make a buy and sell trade at exactly the same time, you'll generate a loss. This is called the spread cost. For example, let's say the sell price of a share XYZ is $150 and the buy price is $151. If you buy one share at $151 and sell it at $150, you will lose $1. This is the spread cost. The wider the spread, the higher the cost for the bigger names such as Apple, Microsoft, etc. The spread cost could easily be just 1 cent per share. Similarly, if you trade currencies, The most frequently traded pairs, like the Euro-USD, for example, will have extremely narrow spreads, while more exotic pairs such as ZAR-JPY tend to have a higher spread. Watch the spreads go when fundamental news is announced. So brokers can change the spread whenever they want to. And your spread will determine your entry level of your trade. So if you're thinking you're going to enter the trade at 100 and your spread is 0.06, you're going to then have to add 0.06 onto the 100 because that will be your entry price. Make sure that brokers keep their spreads low and make sure you don't enter the trade anything less than 5 minutes before the fundamental news. 5 minutes before the fundamental news, the stock will then have a higher spread, or the instrument will have a higher spread. Go and have a look at NASDAQ at 2 o'clock our time, 3 o'clock our time, 3:30 our time. You'll notice a difference in the spread trading. Leverage or margin rate. Trading on leverage or margin basically means that you borrow money from the broker to trade. For example, if you have a margin account at a US stockbroker and deposited $5,000 cash, you may actually buy stocks worth more than $5,000 if you want, depending on your leverage, of course, but you'll have to pay interest on the money you borrowed. The interest rates brokers charge can differ widely. Some brokers will charge 5% or more for the USD margin, while others have reduced their rates to 1 to 2% because of the Fed has also slashed its interest rates. Go and have a look at the leverage. The lower the leverage, the harder it is to trade in terms of margin. Leverage and margin rates will be discussed at a later time, the minute we start talking about costs of the business and trading opportunities. This is the end of video 2, section 1. We'll continue with these costs in a few minutes. Cheers, guys.